You're watching the headlines cool down and you can feel it in your gut. If the Greenland standoff is easing, did I just miss the top? Should I sell my gold and silver right now? Listen, markets love one thing more than truth: panic. And panic makes people sell the exact thing they should be holding, for the exact reason they bought it. So today, we're going to separate two stories that look identical on the surface, but are totally different underneath. Story 1, the daily news. Story 2, the debt trap. Because if you sell based on story 1, you'll get chopped up. If you sell based on story 2, you'll leave with your skin and your profits. And yes, I'm going to give you a clear exit framework for 2026, when to take profits, what signals matter, and what levels I'm watching. Quick disclaimer, this is not financial advice. This is a decision framework, so you stop reacting and start thinking. Let's begin. When should I sell? The debt trap versus the daily news. First, the Greenland standoff cooling down is a headline event. It changes sentiment fast. It can erase a risk premium in hours. It can trigger a flush, a dip, a fake breakdown, and then a reversal that leaves late sellers staring at the chart like it betrayed them. But here's the question that matters. Did the structural reason you bought gold and silver disappear? Because if your thesis was, I'm buying because there's a specific geopolitical flare-up, then yes, when that flare-up fades, you reduce. That's trading. But if your thesis was, I'm buying because the system is trapped, then a calmer headline is just noise. And right now the system still looks trapped. The Federal Reserve's independence is under scrutiny. That alone is rocket fuel for uncertainty. And on top of that, interest rate cuts are still on the table for 2026. People are talking 50 basis points. So you don't sell because a headline cooled down. You sell when the conditions that feed metals reverse. Here are the two cleanest signals. Signal A, real yields. Signal B, the gold to silver ratio. Let's make these simple. Real yields are what you earn after inflation. When real yields are negative, cash is bleeding quietly. When real yields turn meaningfully positive, cash becomes competition again. Gold and silver love. Negative real yields. Gold and silver struggle when real yields are decisively positive and staying there. So if you're asking, when should I sell? The answer is, not when the news calms down, when real yields turn positive again and stay positive. Not for a day, not for a week. I'm talking about a clear regime change you can see. Now the second signal, the gold to silver ratio. Right now you're telling me it's around 51. The ratio is simply how many ounces of silver equals 1 ounce of gold. When the ratio falls, silver is outperforming. That's usually when the silver trade gets crowded, euphoric, and dangerous. Historically, many cycles have shown a sell zone in silver when that ratio compresses into roughly 35 to 40. I'm not saying it has to hit that exact number like a magic spell. I'm saying it's a warning light. So here's your first framework. If real yields are still negative or sliding, and the ratio is still above that compression zone, you do not panic sell because a standoff cooled. You manage the position, you tighten the plan, you stop watching every headline like it's your doctor calling with test results, because metals don't die from one calmer day. They die when money becomes rewarding again. Now, let's talk about silver specifically, because this is where most people get emotionally wiped out. Silver breakout, you need to hear this. Bull flag, not collapse. When silver is near a breakout zone, especially around big round numbers, your enemy isn't bad fundamentals. Your enemy is the stop-loss hunt. You saw it. Western silver ETFs like SLV can drop 8 to 10% intraday, fast, violent, humiliating. It feels like the market is punishing you personally. But what is it really? It's weak hand flushing. It's the market shaking the tree to see what falls out. Think of it like this. If you're a large player and you want physical exposure, you don't want to pay the highest possible price with the most crowded sentiment. So what do? You create a moment, a breakdown candle, a scary headline, a top is in vibe, and you let retail dump their position into your bid. That's why you can see a sharp dip that doesn't match the bigger structure. That's why you can see a brutal red candle, and then the market stabilizes like nothing happened. So if you're staring at a chart and asking, is this the end? Here's the technical narrative I want you to hold. This can be a bull flag consolidation, not a collapse. A bull flag is when price spikes, then drifts and shakes out, then continues. It is designed to make you sell before the next leg. Now combine that technical pattern with the real fundamental update you gave me. Industrial demand from solar and AI data centers is still in a structural deficit. That's huge, because it means the driver is rotating. Earlier, the rally was fueled by geopolitical stress. Now the breakout can be fueled by industrial scarcity. That's a different beast. Geopolitical rallies can fade. Industrial deficits do not politely disappear because the news got calmer. Solar doesn't stop, data centers don't stop, electrification doesn't stop, and when inventory is tight, the fight becomes about availability, not price. So what do you do with that? You stop treating every dip as a signal to abandon the trade. You treat dips as information. Who is getting forced out and where is the market defending? Here's a simple rule. If the dip is driven by sentiment relief, but real yields remain negative and industrial demand remains tight, it's not a thesis break. It's a test. And tests are where weak hands get removed. Okay, now we're going to get practical. Because you don't need inspiration, you need an exit plan. My silver exit strategy for 2026. Profit-taking levels. If spot is nearing $100, a lot of Western stackers are thinking the same thing. I just want my principal back. That's not greed. That's survival. That's a normal human response after volatility. So here's a clean, calm strategy that respects both reality and upside. Step 1, decide your core position. This is the part you will not touch unless the big signals change. Step 2, decide your trading position. This is the part you allow to move at levels. Now your framework suggests sell 25% at 105. Why 105? Because round numbers are psychological battlefields. Because $100 is the headline. 105 is the next zone where sellers love to ambush. And because taking partial profits there does one priceless thing, it pays you. It turns the trade from hope into house money. So imagine your position as a ladder. At 105 Ives, you sell 25%. You recover a chunk of principal, you lower your emotional temperature, and now you can hold the rest without flinching at every candle. Then what? You hold the remainder for the hyper bull case, something like $175 to $200 that you've seen floated by very aggressive forecasts. Now listen carefully. You do not need to believe in $200 to plan for it. You only need to be positioned so that if it happens, you're not the person who sold everything at $101 and spent the rest of the year coping in the comments. So the strategy becomes, take partial profit at a resistance zone. Let the rest ride with rules. Now, the obvious question. What if it never goes to $175, $200? Then you still win because you already took profits, you reduced risk, and you didn't turn your portfolio into a one-way bet. That's what an exit strategy is. It's not a prediction. It's a set of actions that keep you sane while the market does what it does. Let me give you the fastest way to blow this trade. Selling because the Greenland tension cooled for a week. Selling because you saw one red candle. Selling because someone yelled top on social media. Selling because you're bored. Boredom is expensive. Panic is expensive. Reaction is expensive. Here's what earns a real sell decision. A, real yields turn meaningfully positive and stay there. B, the gold to silver ratio compresses into that 35-40 danger zone. C, the market shows distribution, not consolidation, repeated failures to rally, heavy volume on down moves, and no quick reclaim after flushes. D, the industrial deficit narrative breaks, inventories rebuild, delivery premiums vanish, and supply stops feeling tight. If A and B and D start flashing at the same time, that's not a dip. That's a regime change, and regime changes are when you stop being romantic. Here's what I would do if I were you, starting today. Write down your why in one sentence. Are you a trader, or are you a hedge against system risk? Mark your levels. 105, DOR, 25% profit take. GSR 40, check, begin tightening. GSR 35, check, serious exit consideration. Pick a schedule, not a mood. Check real yields weekly, not hourly. Check ratio weekly, not emotionally. Decide your panic rule. If silver drops 10% in a day but the big signals haven't changed, you do nothing for 24 hours. You let the adrenaline burn off. Because most bad sells happen in the first hour of fear. The market doesn't punish intelligence, it punishes impatience. When the Greenland Standoff cools, the crowd wants to believe the danger is over, but debt traps don't dissolve because diplomacy smiled for a day. The deeper force is still there. Confidence, purchasing power, and the cost of money. If rate cuts are still on the table, if Fed credibility is questioned, and if real yields are not decisively positive, then metals still have oxygen. So your decision is not sell or hold. Your decision is, are the conditions changing, or is the noise changing? Because if it's just noise, selling is how you donate your position to someone calmer. So, when should you sell your gold and silver as the Greenland Standoff cools down? You don't sell because the news calms down. You sell when real yields flip positive and stay there. You sell when the gold to silver ratio compresses into the 35-40 exit zone, and you manage silver with partial profit taking, 25% at 105, so you can hold the rest for the true upside without becoming a prisoner of the chart. If you want, drop a comment with one word. Yields, if you're watching real yields, or ratio, if you're watching the gold to silver ratio. And if you want my weekly checklist for what to watch next, subscribe, because the next phase of this move won't be driven by headlines, it'll be driven by scarcity. When I say real yields, most people hear it like it's a Wall Street spell. So here's the street version. If the bank pays you 4%, but your cost of living is rising 6%, You didn't earn 4%, you lost 2%. That's real yield. And the reason it matters is because gold and silver are not competing with stocks in your brain. They're competing with safe money. If safe money is secretly losing value, metals look smart. If safe money starts paying you more than inflation, metals have a tougher job. So what do you watch? You watch the relationship between bond yields and inflation expectations. You watch whether the market believes the Fed is winning or bluffing. And in a year where the Fed's independence is being questioned, you can get weird outcomes. Cuts that come too early, reigniting inflation expectations. Cuts that come too late, breaking something, forcing emergency easing. Or a political storm that makes investors demand a higher risk premium on U.S. debt. Any one of those can keep real yields from staying comfortably positive. That's why the headline cooling is a distraction. It's like the fire alarm stopped beeping, but the wiring is still melting behind the wall. Now about the gold to silver ratio. Don't treat it like a prophecy. Treat it like a mood ring for the market. When the ratio is high, silver is hated, ignored, underowned. When the ratio compresses fast, silver becomes the hero, the meme, the obsession. And when silver becomes everyone's favorite, that's when it does the most damage. Because that's when leverage, options, and I can't lose money show up. So when you hear 35.40 is the exit zone, think of it like this. That's the hallway where euphoria starts walking toward the stage. You can still make money in that hallway, but you don't sleep there. You keep your shoes on. You keep your keys in your hand. Here's a mistake that ruins people. They treat gold and silver like twins. They're not. Gold is the slow, heavy insurance policy. Silver is the wild cousin who shows up on a motorcycle, so your selling logic should be different. For gold, you sell when the monetary regime normalizes. You sell when real yields are positive and stable. You sell when the market is paying you to hold cash again. For silver, you sell in layers. Because silver can overshoot violently, and if you wait for the exact top, the market will humiliate you. So think like a ladder. First rung, take a slice at a 105. Second rung, if the ratio starts living under 40, you tighten again. Third rung, if the ratio pushes toward 35 and silver is acting manic, you consider a bigger reduction. And you don't have to sell to dollars only. One of the cleanest, least emotional exits in metals is this. Rotate silver profits into gold. Why? Because in late cycle euphoria, silver can spike faster. Then when silver cools, gold often holds value better. So instead of trying to time the exact peak, you harvest silver strength and park it into the steadier metal. That way you stay in the hard asset world, but you reduce volatility. Let's map the year like a movie. 3 possible endings. Scenario 1, soft landing theater. The headline's calm, growth holds up, and real yields drift higher. In this world, gold goes sideways and silver gets choppy. Your plan, take that 25% at 105s, get paid, keep the core, and watch yields like a hawk. Scenario 2, Fed credibility crack. Cuts come, but inflation expectations won't die. Real yields stay weak. In this world, gold remains strong and silver becomes the aggressive play. Your plan, don't sell your core on noise, scale profits on spikes, and respect the ratio if it compresses fast. Scenario 3, something breaks. A funding stress, a debt scare, a policy accident. Pick your poison. In this world, the market doesn't care that Greenland is quieter. It runs to safety, and metals can gap up in days. Your plan. You will be grateful you didn't sell everything because you got spooked by a cooling headline. You don't need to predict which one happens. You need a plan that wins in all 3. That's what we're building. One more thing, because it matters. ETF silver can drop faster than physical silver feels in real life. Paper can be sold instantly. Physical has friction, premiums, shipping, dealer spreads, inventory delays. So if you're holding physical and you're watching an ETF candle, understand what you're really seeing. You're seeing liquidity panic in paper, not necessarily a sudden abundance of metal in the real world. So before you sell everything, ask, are premiums collapsing? Are back orders gone? Are dealers begging for inventory? If the answer is no, then the physical market isn't confirming the fear, and that matters. Here's how you prevent the worst feeling in investing. The feeling of selling, and then watching price rip higher. Use the 2-sentence rule. Sentence 1. If my first profit target hits, I will sell a slice. Sentence 2. If my big macro signals flip, I will sell more. That's it. Not, I will sell when I feel scared. Not, I will sell when the comments section panics. Because emotions are the one indicator that always lies. Let me be honest about what most people mean by, when should I sell? They're asking, can you tell me the top so I don't feel foolish? No one can give you that, but I can give you something better. A plan that makes you profitable even if you're wrong. Taking 25% at $105 is not weakness. It's payment. Watching real yields is not boring, it's adult. Watching the ratio is not superstition, it's crowd control. And ignoring headlines is not denial, it's discipline. Picture this. The Greenland Standoff cools. The TV lowers its voice, the market exhales, and right when everyone thinks it's safe again, that's when the structural problems quietly pull the lever. Debt doesn't disappear because diplomacy smiles. It sits there, compounding, demanding more interest, demanding more issuance, demanding more faith. And metals, at their core, are faith insurance. So if you're going to sell, sell because the faith problem is fixed, not because the news cycle took a nap. Should I sell everything at once? Almost never. One all-in sell is how you turn a good move into a regret story. What if price hits $105 and then immediately goes to $130? Good. You still have 75%. You got paid, and you kept exposure. What if price never hits $105 and just fades? Then you didn't chase a profit take. You followed the structure. If the macro signals flip, you exit based on evidence, not hope. Do I set a stop loss? If you're trading paper, maybe. If you're holding physical as insurance, a hard stop can force you out at the worst time. Instead, use signals, real yields, ratio compression, and whether dips are reclaimed quickly. How do I avoid selling into a wick? Use limits, not market orders, and give the market room. Silver loves to stab below obvious levels and reverse in your face. Core thesis. I own metals because real yields are weak and trust is fragile. Trigger to take profit. Silver tags $105, sell 25%. Trigger to tighten. Gold to silver ratio under 40. Reduce risk on spikes. Trigger to exit. Real yields turn positive and stay positive. Plus ratio near 35 to 40. Plus physical tightness disappears. Optional move. Rotate a portion of silver profits into gold to keep hard asset exposure with less volatility. That's it. One page. No drama. If Greenland cools today, good. Let the market breathe. But don't confuse a calmer headline with a healed system. Watch the signals, take profits in layers, and let the crowd fight over candles while you manage the cycle. And if you're feeling that itchy urge to do something right now, remember this. The biggest money is made in the quiet middle, not the noisy turning points. The crowd sells when fear is loud and buys when comfort is loud. Your edge is doing the opposite, calmly, mechanically, with receipts. The plan isn't exciting, but it works. Set a weekly reminder. Every Friday, check real yields, check the ratio, and write one line. Regime improving or regime deteriorating. If you can't justify the line, you don't touch the position. Simple. That's how you trade like a pro, not a headline addict. Drop yields or ratio in the comments so I know what you're tracking, and I'll build the next video around that.